So in order for us to calculate these ratios, we need some information. One of the things we need to do is have a balance sheet. This is the account form balance sheet. I know the one we did before was a report form where everything was in a column. The account form balance sheet will show the assets on the left and the liabilities and equity on the right. So it kind of reflects the accounting equation in that way. So for us to calculate the current ratio, what we need, again, is we need to take our current assets and divide them by our current liabilities. So in order to do that, we need to calculate what are our current assets and what are our current liabilities. So remember, a current asset is an asset that we expect to be turned over or used up within a year. So cash, accounts receivable, office supplies, merchandise inventory, and prepaid insurance are all expected to be turned over or used up within a year. Fixtures, those are a plant asset, right, like we talked about earlier. So fixtures would not be part of our current ratio calculation. With our current liabilities, we have this long-term note payable, meaning that this is due sometime after a year. So our current liabilities would include accounts payable, interest payable, and salaries payable. So what we need to do is calculate our current assets. So we have 99,000 plus 108 plus 6,000 for the supplies plus 140,000 for the merchandise inventory plus 20,000 for the prepaid insurance. So that gives us 373,000 in current assets. Now our current liabilities would include the accounts payable plus the interest payable of 10,000 plus the salaries payable. So that gives us 202,000. So our current ratio is going to be 373,000 divided by 202,000. Current assets divided by current liabilities. So our answer is 1.85. So our current ratio would not be expressed as a percentage, but only as a number. And what it means here is that we have $1.85 in current assets for every dollar in current liabilities. So we could comfortably pay our current liabilities with our current assets without having to dip into our long-term assets. So this is a very important ratio for a creditor or an investor. Even for yourself as a business owner, so you know that you're not in danger of not being able to pay your current liabilities. Okay? The working capital is current assets divided by current liabilities. Minus current liabilities. And that just gives you an idea of what you have to work with in the short term. So this is a dollar amount, of course, right? It's 373,000 minus 202,000, which gives you 171,000. So if you had to turn these assets into cash, plus the cash you already have, you would have 171,000 to pay your current liabilities with. Okay, so it gives you a level of comfort that, you have some cash there if you need to take care of your current liabilities. Okay, so this is important, again, to realize that. So that way, again, you don't have to overly worry about short-term debt. Now, the inventory turnover ratio is designed to let you know and let investors and creditors know how quickly you're turning over your inventory. How many times a year are you turning your inventory over? In order for us to know this, we have to know what our average inventory is. And we do that by taking the beginning, okay, for the inventory at the end of the last year, plus the ending, for our inventory at the end of this year, and dividing it by 2. So we're going to take the 160 that we had at the end of last year, plus the 140 that we have at the end of this year, and divide that by 2. So that gives us our average inventory. Not a perfect measure of that, but it gives us a basis to do the ratio on. So we will need the cost of goods sold, which we have here. Okay, so if we had the income statement, we wouldn't need this here, but we don't. So we have that here. So we're going to take the cost of goods sold of $241,000, and we're going to divide it by the average inventory of $150,000. So that's going to give us 1.61. So that's telling us we're turning over our inventory 1.6 times per year. So not a lot. Now, is this normal for this company or for this industry? We don't know. Okay, but we can calculate the days that it's taking to turn over their inventory. In other words, sell the inventory they purchased and then start a new inventory. So we would take 365, okay, and divide that by 1.61, and that will give us 227 days. So it's taking us 227 days to turn over our inventory. So again, we don't know if this is normal for this company or for the industry they're in. Okay, so we have to put numbers in context as well, just like the average collection period. So we can see most of their, most of their sales. Okay, we could assume are credit sales. We don't really know, but we need to get our average accounts receivable in order to determine our average collection period. So again, we take the beginning, which was $114,000. That was the accounts receivable at the end of the last year. And then we need to add the ending, which is the accounts receivable at the end of this year, and divide it by 2. Right? And we get 111,000. So we're going to take our net credit sales, right? Any cash sales would not be included in this because we would already have the money. So we're going to take the net credit sales of 461,000. We're going to divide it by the average accounts receivable of 111,000, and that's going to give us 4.15. That means we're turning over our receivables roughly 4 times per year. Okay? If we want to put that in days, we would take 365 and divide that by the collection ratio, and we would get 88 days. So it's taking us 88 days on average to collect our receivables. Again, if the terms this company uses is 90 days, we're doing great. If it's 30 days, then they have some work to do. If it's normal in this industry to have 88 days, or this is the history of the company, you can put it in context. So these ratios are important for you as a business owner, to understand these. And if you allow your customers credit, this is really important. If you sell inventory, this is important. You want to know these things because it's going to affect your cash flow. So I thank you for your attention.